In early 2026, the Turkish government broadcast a highly optimistic message to foreign investors. The political announcements outlined an incredibly lucrative landscape: decades of tax-free foreign income, sharp corporate tax cuts, and a wide open door for multinational wealth. But political announcements do not carry the weight of law. The actual enforceable rules are bound inside Law Number 7582. The enacted statute is much narrower, highly specific, and loaded with strict conditions that the headlines left out. Behind the promised tax breaks are layers of specific tax security mechanisms. Accessing these benefits requires navigating mandatory 10% domestic minimum tax floors, exhaustive 22-step Social Security checklists, and multi-tiered documentation requirements. Surviving this landscape requires absolute precision. Because Law 7582 is narrower and more precise than the headlines suggest, miscalculating an adjusted tax base or missing a filing deadline leads directly to heavy tax penalties and the forfeiture of the incentives you came for. We can break down how this actually works by looking at 3 specific investor profiles. The very first is the wealthy returnee. This category covers high net worth individuals and members of the diaspora relocating their capital to Turkey. This timeline shows individual incentives. Tax rates on foreign income plunge, staying exempt for 20 years, and inheritance tax drops to 1%. Additionally, an overlaid wealth amnesty chart shows penalties sliding from 5 to 0% for holding assets in Turkish financial instruments. The friction here lies in the eligibility test. To qualify for the 20-year exemption, you have to prove a completely clean 3-year history of non-residence. A minor historical connection, like an active commercial tax liability from 4 years ago, can permanently disqualify you. These historic tax breaks are inaccessible if you wait until the government asks for proof. The entire evidentiary paper trail, documenting where you lived and paid taxes, must be gathered, translated, and authenticated before you cross the border. The second profile covers multinational tech and service groups. For these corporations, the incentives are structural. The digital services tax scales down to 2.5%, and key deductions for companies inside the Istanbul Finance Center are legally extended to 2047. The primary threat to these corporate incentives comes from outside Turkey. Multinationals with over 750 million euros in global revenue are subject to the OECD's Pillar 2 rules, specifically the 15% global minimum tax floor. This bar chart illustrates the floor. If a multinational uses Turkish deductions to drop their tax rate near zero, the government automatically tops up that rate to hit the 15% threshold, ensuring revenue stays in the country. To monitor this, Turkey enforces an aggressive 3-tier transfer pricing documentation system. Operating here requires submitting a comprehensive master file and a country-by-country report, mapping out exactly where the corporate group generates its profits and pays its taxes. Multinationals also face the permanent establishment trap. Having remote executives managing projects from a laptop in Istanbul can legally classify as a fixed place of business, unintentionally triggering full corporate tax liability. For massive corporate groups, local tax deductions provide minimal benefit if their sheer global scale and scattered workforce trigger international tax floors and local audits. Our final profile is the foreign-owned manufacturer. For companies with an industrial registry certificate, Law 7582 enacts a highly specific 12.5% tax rate applied strictly to production earnings starting in 2027. This requires actual physical production. You cannot simply buy and export goods. You must physically stamp and assemble parts on a line inside the country. The back-end friction for these manufacturers is the domestic minimum corporate tax. Even after applying the 12.5% rate and other incentives, the final tax bill cannot legally fall below 10% of their adjusted commercial profit. Staffing that production line introduces a severe administrative hurdle. Hiring foreign engineers and managers triggers the SGK Social Security system, an unforgiving 22-step registration process, where missing a single requirement can trigger retroactive fines. Foreign manufacturers face a delicate act. They benefit from heavy tax cuts, but only if they maintain compliance through intensely bureaucratic hiring and reporting. Turkey's 2026 landscape operates on a strict duality. The financial rewards for entry are incredibly lucrative, but the administrative systems guarding those rewards are entirely intolerant of sloppiness or retroactive fixing. Relying on grand political promises is a liability. The legal reality is dictated by the exact language of the enacted statutes, enforcing the fine print. Securing these benefits requires building comprehensive evidentiary files long before you need them. Tracking visa timelines, mapping transfer pricing, and proving historical tax compliance must happen before a single transaction takes place or an auditor knocks on the door. Operating in Turkey in 2026 is no longer about finding offshore loopholes. Success depends on identifying exactly where your business fits within a rigid, highly documented legal matrix and executing the paperwork flawlessly.